I'm Alan Kenny, Managing Editor with REIT.com, and I'm in Washington, D.C. at NAREIT's Washington Leadership Forum. Joining me is Judith Fryer of Greenberg Traurig, a corporate securities lawyer, to talk about some of the latest developments on both the public REIT side and the non-traded REIT side. Judith, we've seen a little bit of activity in the IPO market so far this year. Do you think we're going to see that boosting up at any point soon?
I am by nature an optimist, Alan, so I would like to tell you that I think there's going to be a whole parade of IPOs. But if you're defining it in the traditional sense of a private company that's doing its first public offering, I don't think things are going to be radically different from last year. Last year, as you know, of the $37.5 billion that were raised in equity offerings by traded REITs, only about 6% of that came from IPOs. And I know we tried to price for a client an IPO last year, and it ultimately got pulled because if you looked at the IPOs that did price, many of them priced below the range. And so if you have a situation where someone doesn't need to be pricing, they're not necessarily willing to take that haircut.
And those public, non-traded REITs, what are some of the big issues there?
Well, they do have some big issues right now. Regulatory issues. There are some proposals. There's a proposal, for example, from FINRA that could, people say, change the way those non-traded REITs are sold. I don't know that it's going to be that draconian, and we're still waiting for them to come out with the next round of the proposals. But potentially, we see that non-traded REITs would have to value once a year. Right now, most of them don't value more than 18 months after the last of their public offerings. That could be a big change if you're seeing the new price for non-traded REITs on an annual basis. They're talking about changing the way these things are held on account statements. If somebody buys something for $10 and immediately it shows up on the account statement for $9, one hypothesizes that that might discourage sales. So that's another possibility.
And one issue that seems to come up a lot with the non-traded REITs are exit strategies. What are you seeing there?
In 06 and 07, the exit strategy was usually merging. And we certainly did a bunch of those back then, and merging into either traded REITs or merging with private companies. As financing comes back, those deals become possible again. But some people may have a bad taste in their mouth from the first round where private companies took some of these non-traded REITs and bought them at prices they're no longer happy with, which is a common story. So, and the other way, of course, of exiting would be to become an IPO, to list and do an IPO, or what most people call an IPO. Anybody can list, that's easy, but most sponsors of these non-traded products don't want to list at less than people paid for them.
Well, Judith, thank you so much for joining us.
My pleasure.
For more on this and other REIT news and analysis, check out REIT.com.